Celestica has returned over 4,000% in 5 years. Its revenue is growing at 55%. It just beat earnings 4 quarters in a row. Every single analyst has revised their estimates upward. And yet, the math says wait. CLS trades on the New York Stock Exchange at $340. The company builds the physical infrastructure that powers artificial intelligence, networking switches, rack-scale computing platforms, and data center hardware for the world's largest hyperscalers. It's one of the most exciting growth stories in the AI supply chain. But exciting and investable aren't always the same thing. Let's break it down. Before we get into the bull case, let's address the red flags. First, the stock is down 28% from its 52-week high of 474. That kind of volatility tells you the market is unsure about sustainability. Second, the valuation. 33 times forward earnings for what is fundamentally an electronics manufacturing services company. Historically, EMS businesses trade at 10 to 15 times earnings. The AI premium has pushed this to levels that require sustained hypergrowth just to justify. Third, the margins. Profit margin is just under 7%. Revenue is growing at 55%, but this is largely hardware pass-through, assembling systems with NVIDIA and AMD chips. The margins belong to the chip designers, not the assemblers. And fourth, customer concentration. A significant portion of revenue comes from a handful of hyperscaler clients. Losing even one would be devastating. I'm Ben, and this is Probable Alpha, where we use probability-weighted models to cut through the noise and find asymmetric opportunities. Celestica operates in 2 segments. The growth engine is Connectivity and Cloud Solutions, or CCS. This is the AI infrastructure business. Networking switches, high-performance computing platforms, storage systems, and rack-scale AI solutions built in strategic collaboration with AMD. Think of Celestica as the bridge between the chip makers like NVIDIA and AMD and the hyperscalers like Google, Meta, and Microsoft. Someone has to take those chips and build them into complete, rack-ready systems at massive scale. That's what Celestica does. The second segment is Advanced Technology Solutions, or ATS, which serves aerospace, defense, industrial, and medical technology clients. It's more stable, but lower growth. Revenue has exploded from $12.4 billion in fiscal 25 to an estimated $19.2 billion in fiscal 26. That's 55% growth in a single year. And consensus expects another 41% growth in fiscal 27 to $27.1 billion. The numbers are genuinely impressive. Revenue of $13.8 billion on a trailing basis, expected to reach $19.2 billion this fiscal year. Earnings per share of $8.24 trailing, with estimates of $10.30 for 26 and $15.08 for 27. That's 70% and 46% growth respectively. Return on equity is 52%, which is exceptional. Free cash flow is $647 million on a trailing basis. The balance sheet carries $378 million in cash against moderate debt at a 45% debt-to-equity ratio. And critically, every single analyst covering the stock, all 18 of them, has revised their earnings estimates upward in the last 30 days. 0 downward revisions. That kind of unanimity is rare. Now, the valuation question. At $340, CLS trades at 33 times fiscal 26 earnings and 22.5 times fiscal 27. On a price-to-sales basis, it's 2.6 times trailing revenue. Compare that to peers. Jabil trades at 12 times forward earnings, Flex at 15 times. Even Dell, which has a similar AI infrastructure thesis, trades at 21 times. The premium Celestica commands is almost entirely based on the growth rate. And to be fair, growing revenue at 55% justifies some premium. But here's the issue. If that growth rate slows to even 20%, the multiple contracts sharply, and the stock could give back most of its gains. You're paying a growth stock multiple for a company with hardware company margins. Why does Celestica deserve attention at all? Three structural drivers. First, the AI infrastructure build-out is the largest technology investment cycle since the internet. Hyperscalers are spending hundreds of billions on data centers, and someone has to build the physical hardware. Celestica is one of a small number of companies with the manufacturing capability and engineering expertise to deliver at this scale. Second, the AMD Helios collaboration. This is a rack-scale AI platform co-developed with AMD, positioning Celestica as more than just an assembler. It's becoming a platform solutions provider. If Helios gains enterprise traction, it changes the margin profile. Third, diversification. The ATS segment in aerospace, defense, and medical technology provides a floor. Even if AI spending cools, Celestica isn't a one-trick pony. Now let's put this through our probability-weighted model. We run 5 scenarios over a 5-year horizon from the current price of $340. We first define what happens in each scenario, then separately assign probabilities using multiple independent signals. Let me walk you through each one. The bull case. AI infrastructure spending proves generational, comparable to the cloud build-out from 2010 to 2025. Celestica becomes a dominant platform solutions provider alongside Dell. Revenue reaches $55 billion by 2031. Margins expand to 10 to 12% as the business shifts from pure assembly to higher value platform solutions, and earnings per share reach around $40. At 22 times earnings, the stock reaches $900. That's a 21.5% annualized return over 5 years. The optimistic base case. AI spending continues robustly for 3 to 4 years, then growth normalizes to mid-teens. Celestica maintains market share and the AMD Helios platform gains meaningful traction. Revenue reaches $40 billion, margins hold at 8 to 9%, and earnings per share reach $25. At 22 times, the target is $550, 10.1% annualized. The standard base case. The AI CapEx cycle matures faster than expected. Competition from Flex, Jabil, and Foxconn intensifies. Revenue reaches $30 billion, but margins compress back towards 6 to 7%. Earnings per share of $15 at 21 times gives you $320. Essentially, flat from here, negative 1.2% annualized. The bear case. AI infrastructure spending peaks in 2027 or 2028 and then contracts. Hyperscalers consolidate their supply chains, squeezing margins. Revenue stalls around $20 billion, and margins revert to traditional EMS levels of 4 to 5%. Earnings per share around $7 at 17 times gives you $120. Negative 18.8% annualized. The tail risk. AI spending collapses entirely. Perhaps custom silicon makes GPU-based infrastructure largely obsolete for inference workloads. Celestica loses a key hyperscaler client. Revenue drops back to 12 to 14 billion. Margins collapse to 2 to 3%, and the stock falls to around $40. That's negative 35% annualized. Now let's assign probabilities using our Mosaic approach, starting with macro and demand signals. AI infrastructure CapEx across the major hyperscalers is running at over $300 billion annually and still accelerating. Enterprise AI adoption is in its early stages. These signals support the bull and optimistic base cases. Company fundamentals. Revenue growing 55%. 4 consecutive earnings beats. 18 of 18 analysts revising up. 0 downward revisions. The AMD Helios partnership adds a proprietary dimension. Strongly supports upper scenarios. Competitive dynamics. Celestica competes with Flex, Jabil, and Foxconn, all capable manufacturers. Barriers to entry in AI infrastructure are higher than traditional EMS, but they're not insurmountable. Celestica's current position is strong but not monopolistic. Cross-industry earnings signal. This is important. Dell's most recent quarter was a blowout, a 64% earnings surprise on AI server demand. Jabil's AI-related revenue has been growing above 40%. Flex recently raised full-year guidance citing data center strength. When multiple companies in the same supply chain are all beating estimates simultaneously, is one taking share from the others, or is the entire market growing faster than anyone expected? The answer is clearly the latter. If Dell were winning at Celestica's expense, you'd see Dell beating while Celestica misses. Instead, every major player is surprising to the upside at the same time. That's a market expansion signal. It means consensus is systematically underestimating total AI infrastructure demand. This tilts the odds toward our upper scenarios and is a key reason we assign a higher than usual optimistic base weight. Valuation signal. 33 times forward earnings on 7% margins is aggressive. The stock peaked at $474 and has already corrected 28%. The market has already shown it will punish any growth deceleration harshly. This tilts probability toward the middle and lower scenarios and partially offsets the bullish demand signal. Putting it together, we assign bull 15%, optimistic base 28%, standard base 30%, bear 20%, tail 7%. On the tail risk, 7% is higher than what we'd assign to a mega cap like Meta or Alphabet, but lower than a speculative biotech. Celestica earns that elevated tail because of three specific factors: customer concentration in a handful of hyperscalers, razor-thin 7% margins, meaning even a modest revenue decline causes an outsized earnings collapse, and the binary nature of AI infrastructure spending. If the cycle turns, it turns hard and fast, as we've seen in every prior tech hardware cycle from telecom equipment in 2001 to crypto mining rigs in 2022. The weighted expected return from those probabilities comes out to 3.9% annualized. Now, our personalized hurdle rate for CLS. We start with the risk-free rate of 4.5%. That's your alternative, sitting in treasuries doing nothing. Then we add a variance-scaled equity risk premium. This is calibrated to the width of Celestica's own scenario distribution. The wider the range of outcomes, the more return you should demand for bearing that uncertainty. For CLS, that premium is 4.9%, reflecting the significant dispersion from the bull case at $900 down to the tail at $40. No country risk premium. Celestica is Canadian headquartered with hyperscaler revenue predominantly in US dollars, so sovereign risk is negligible. Total hurdle, 9.4%. The spread is negative 5.5%. CLS does not clear the hurdle at this price. Why you might disagree? First, the growth rate could accelerate rather than slow. If AI infrastructure spending doubles from here, and some estimates suggest it could, Celestica's revenue trajectory could surprise to the upside. Second, the margin expansion story is real. The shift from pure EMS assembly to platform solutions via Helios and other proprietary offerings could structurally lift margins above traditional EMS levels. Third, the earnings beat streak suggests consensus is consistently too low. If Celestica beats again this Thursday, earnings are July 27th, the stock could re-rate quickly. And third, the earnings beat streak suggests consensus is consistently too low. If Celestica beats again this Thursday, earnings are July 27th, the stock could re-rate quickly. And fourth, the stock is 28% off its highs. Some argue the correction has already priced in the risks. Key risks to monitor: customer concentration. Any signal that a major hyperscaler is shifting volume away from Celestica would be material. Margin trajectory. Watch gross and operating margins quarterly. If they're expanding, the bull case gains credibility. If they're compressing despite revenue growth, the EMS commodity trap is real. AI CapEx durability. Any slowdown in hyperscaler capital expenditure guidance directly impacts Celestica's revenue pipeline. Competition. Monitor Flex and Jabil's AI infrastructure growth rates relative to Celestica. And currency, Celestica reports in US dollars but has significant Canadian dollar cost exposure. But here's why Celestica stays on the radar. The growth is genuinely exceptional. 55% revenue growth is not something you find often in a $39 billion company. The position in the AI supply chain is structural, not speculative. The AMD partnership adds a proprietary moat that pure EMS competitors lack. Free cash flow is positive and growing, and the stock has already corrected meaningfully. You're not buying at the absolute peak. The issue isn't the business. The issue is the price. At $340, you're paying for perfection, and perfection rarely lasts in hardware businesses. The verdict. At $340, Celestica is a pass. The expected return of 3.9% does not clear our 9.4% hurdle rate, giving a negative spread of 5.5%. But this is a stock to keep on the watch list. At around $250, roughly a 26% pullback from here, the math starts to work and this moves to watchlist territory. At $200, a 41% pullback, this becomes a buy, and likely a strong one. The numbers to watch are Thursday's earnings report, gross margin trajectory, the AMD Helios pipeline, and hyperscaler capex guidance. If Celestica can demonstrate margin expansion alongside revenue growth, not just revenue growth on flat margins, the investment case changes materially. As always, this is analysis, not a financial recommendation. Do your own thorough due diligence before deploying any capital. All investments carry risk, including the potential loss of your entire principal. If you found this analysis useful, hit subscribe and like for more probability-weighted investment breakdowns. See you in the next one.